When we first start trading, we believe our strategies will last forever. It's one of the most dangerous assumptions every new trader makes. In today's episode, we're going to be talking about strategy shelf life, whether that be classic strategies like trend following and mean reversion, or if it'll be things around correlation. We'll talk about how to spot when your edge is disappearing and why some strategies die faster than others. Let's get straight into this episode. When I was first getting into trading, I assumed all strategies I'd learn would last my whole career in trading. I think it's the most common assumption for most people getting into trading, but it's a very rude awakening when we all realize most strategies have a shelf life, and some are very short, some are a bit longer than others. But in this podcast, we wanted to go over all the different types, also going over different kind of categories. So sometimes around correlation, or if it's just around risk premium or inefficiencies. So do you want to start, Padma, or do you want me to start with kind of going over some main topics for it?
We can I can start like with the trade we discussed around like the high PTC long and short trash
Sure.
theme.
I think that
Maybe
sounds
that,
perfect. Yeah, let's do it.
yeah. So there was this idea early this for the past let me see, for the past year or two, that if you were long like BTC and you short what's called like trash coins, whatever, you would have done very well, and you could have run that almost almost in a delta neutral type way, and you would have done very well doing that. The problem is we are having now a mini bull cycle, right? And in a bull cycle, the dynamics are different. It's like BTC usually stalls, and you see a bunch of altcoins, like every altcoin that you touch probably makes money if you hold it for 5 or 10 days, right? And so that generates a problem for this type of strategy, even though they are smart and they've made money over the past 2 years. When you are holding a lot of risk on that short leg, because you are shorting trash that is also very volatile, right? And so you are taking when those dynamics shift and Bitcoin starts to stall and these altcoins start to go up, you start losing a lot of money on that short leg and start underperforming the overall market. And it's interesting because everybody, like for the past few months, you see people start opening vaults around vaults. When I say vaults, is like places where you can to put your money in, and other people trade it for you. And then people started making like vaults around this idea of going long BTC and going long other quality coins and short the trashy ones. And now, if you see their performances, you see that they did very well for a few months, and now they completely crashed the returns. And that's markets, some of these edges, you have almost no data for them, and you take them while they're working, and you try to guess estimate, like, okay, if this stopped working, what should I do? But yeah, I don't have much else to say other than these correlations, these statistical relationships have a tendency to eventually break if one is not thinking carefully about them. Now, am I saying that we shouldn't have put this trade on? No, I don't think so. But it's hard to make an argument when you are losing, when you don't have a lot of data for it, if that makes sense.
Yeah, I think so. It reminds me of in small caps when you used to get like one really big runner. So let's say it was in oil or AI, or recently it's been the crypto treasuries. And then you'll get many sub runners that are somewhat linked to the narrative. So whether that be that they maybe hold a bit of crypto, whether they're maybe opening a treasury, or if it was when it was AI, when they're introducing a bit of AI into the company or whatever, you get those sub runners that were mainly being led by the main runner. And at some point, they would no longer be correlated. But it was very hard to tell exactly when, and often it would be like a lagging signal. But if you were early enough to it, you could buy these sub plays and you'd be able to catch very nice returns, sometimes multiple of the returns of the main runner, because the main runner had already exhausted most of its move. But I think you're right. It's not like we shouldn't take advantage of these, but as with any strategy, they do have shelf lives. And I think correlation ones, at least these sort of correlations that we're talking about, not general, whole wide market ones, often don't last very long. In small caps, it would maybe be a couple of days, maybe a week or two if you're lucky. In crypto, I'm assuming it's I don't know, I guess a couple of months, depending on what kind of regime it is.
Yeah, or this one, maybe this one lasted since 2023, at least the juiciest part of the returns, basically.
No, it makes sense.
Because everyone is allocating to BTC, right? You see these ETFs, you see the play into the new administration in 2024. Like there were a bunch of factors that made everyone pile into the main asset that is BTC, and all else mostly everything else before Hyperliquid and Solana and others, like all else went to, declined. And so if you run this book, like with the same amount of money, like risk adjusted to volatility, if you could run a delta neutral like book and capture the returns from one and capture the returns from the other trash that was always going down. And that's fine in games until now that everything is pumping and you are getting, basically you're getting a lot of losses on that short leg.
Makes sense. I think also then, I guess, the pivot to more like, I guess, common strategies, which would be inefficiencies or risk premiums. For the most part, if I had to say most strategies, like if you had an easy way to monitor how long a shelf life would be, I would often base it on sample size or like frequency amounts. Like I think a great example is like Robert Calver's strategies, where a lot of his are on daily, weekly. I think he has some maybe intraday, but I think most of them are daily and weekly timeframes. And often those sort of strategies can have a very long shelf life. But they also do have one key issue, that because they are low frequency, it's very difficult to know when they are starting to no longer work, basically, because you're not getting that many trades per week or per month, etc. It means it can take a while before you actually really notice that, hey, performance is not matching up anymore, which is just one of the downsides. But you do get the upside of that. Most of the strategies, also from my own experience, like I have one using internal bar strength that has lasted a very long time on all the main indices. It's a very simple signal, but for the most part, it's maybe getting 2 signals every quarter, maybe 3 signals if I'm lucky, if it's kind of volatile. But that's very difficult to first backtest because you don't have that many samples to go over. And then 2, as I was saying, it's difficult to know if that's like no longer working. I assume you have a similar issue in yours, right? Because yours are very high time frame.
Yeah, exactly. You in any strategy, investment, whatever you're making, like you need to understand what is the underlying thing that you are betting on. Is it sticky? Is it going to be around? If you are betting on something like, let's make the extreme example that you are betting on a pair straight, right? You are betting on Amazon correlation with Tesla. Let's say I'm making it up, and you see that there's some correlation there for the past 2 years, whatever. Why should it be there a correlation there? Probably there's no reason, and if you don't have a reason for the trade that you put on, it's going to be really hard to make the case when it stops working to continue to allocate into that. The style of trading that I do is what's called the risk premium harvester, whatever. And I know that momentum and these effects tend to be sticky over time because there's dynamics behind it that are pretty well studied and have worked for many decades, and it's based on human psychology, on also on like how can you say, hedging effects, behavioral patterns, stuff like that. And you can make an argument that effect that I'm harvesting is going to be sticky going forward. You never know for sure, of course, like everything is risk. That's why it's called the risk premium. But you can make a reasonable estimate that it's going to continue to work. When you have something that you don't understand, or that it's very, like it's a new thing, you need to treat it like it is. You can still harvest it and try to trade around it, but you need to understand it is probably temporary, and you are going to have to pull the plug eventually.
Yeah, no, I totally agree. I think that's also a really good point, is understanding underlying, like, what are you trading around and what's the strategy based on? Because if you're, like, a very easy example to understand is if you're doing something that's based on arbitrage, so you're exploiting, buying and selling on 2 exchanges or whatever, if that gap or spread difference no longer exists, then you no longer have an edge there. Maybe you have an edge in other exchanges, but at least for that particular exchange, it's no longer present. That's a really easy way to see instantly, hey, the strategy no longer works. It becomes more difficult when it's based on more whether it be trend following, even though for the very long time horizon trend following has worked. But if you're doing, let's say, like a mean reversion strategy and you have a kind of lower time frame signal, it's going to take a bit further over time to see if it's no longer working. For me, what I try and base on as well is, are there key performance metrics I can look at, which are the derivatives of like what I'm underlyingly trading? So for example, if I'm doing mean reversion and the win rate percentage drops significantly for a long period of time, then I'm thinking that signal for mean reversion is no longer as effective or is no longer working. Because in mean reversion, you ideally want a high percentage for win rate because it's reverting, unlike trend following, which is lower percentage win rate. So that's like a key, at least performance metric I would look at. Other people, obviously, you can look at like Sharpe ratio and things like that. Is there anything you look at specifically in performance metrics? Because I know I always get asked the question, like, what's the best performance metric to see if a strategy is or not working? And I think At least in my opinion, it's a blend of all of them. But what do you think?
It's a very hard question, to be honest. It's like I'm lucky, lucky, not a word, but to be trading a strategy that I have some confidence that it will continue to work because it's basic risk premium, right? Then I'm going to talk to my experience. So in this type of strategy, what I do is I don't care really for any single like performance metric, right? But I do care if I'm underperforming like certain peers benchmarks. Not the S&P 500 or not Bitcoin. But for example, what is the simplest possible trend following model in crypto is looking like in returns? Or a more complex one, what is looking like? Or even better, someone that is actually trading like a friend or someone you know, and he shares performance. How is he doing in this specific niche that I also trade? And then I compare my own performance with those people. And if I'm underperforming for no reason, then I'm preoccupied. I'm doing something wrong, right? But if I'm in par with them or better, okay, great, I'm doing well. But I know that that's why I said I'm lucky, because I know that that is not the reality for all edges, because there's other very niche edges. For example, the one that we were talking about, or the arbitrage opportunities. The arbitrage is a bit more clear because you either have money there to be made, like the arbitrage is there, or it isn't. But for example, you've been whatever harvesting some weird market making DEX being making market making on a new exchange or something, and suddenly you start seeing your equity curve declining. And it's really hard. I wouldn't know what to do. Probably would have to understand if there's a new player doing the same things as I am, looking at that data, see what's going on. But yeah, in risk premium, it's pretty standard. You just go in benchmark against what other people are doing or your own backtests. On more niche edges, you have to use a bit more of your intuition in what you understand about that edge. But yeah, at some point, if you start losing money every month on it, you need to cut it off at some point, right?
Yeah, no, I agree. I also think for the most part, people are overreactive to thinking their strategy is no longer working. It's not as common that I would see someone that maybe takes too long to respond to a strategy not working, mainly because losing money is very painful. So if you're losing money for even a small period of time, it kind of gets you to take some sort of action, which is not always needed. So if I had one piece of advice for it, I would try and remain in a strategy a bit longer than you initially feel, at least if you're somewhat sensitive to losing the money. Now, obviously, if you've been trading for a while and you're a bit numb to it, let's say, then obviously you just have to kind of be logical about it. But a lot of newer traders I've met, they'll go into a 1 week drawdown and then think, hey, this strategy is no longer working. Or they'll see maybe their Sharpe ratio drop lower for a week or two. That, for the most part, is very common. I do try and say to a lot of people that underperformance is completely natural in trading. Like you're going to get time periods where you're going to underperform other strategies or other versions of trading, but you need to understand, is this a time that, as you were saying, for a particular strategy, should it be performing well right now? Is every other strategy that's doing trend following or something similar to you performing really well and you're not? Or is it that everyone's having a bit of a hard time now and you're underperforming as well, but overall you'll have a different regime maybe that works more to your particular strategy?
Yeah, completely agree. One of the biggest issues with newer traders and people investing in the market is that the tolerance of pain, right? And if you're going to do this at any like professional capacity, you need that tolerance of pain, and I don't think that's gained like through reading books or academic papers. You really have to go to the trenches and really experience those volatile rides, right? It's all fun in games to see a 10% or 20% drawdown on a beautiful equity curve on a Python script than it is to see losing $100,000 in a single day or something like that. It's psychologically different. So you will only, and that's why so many fail as well. It's, even though I make fun of trading psychology for the most part, there's still some aspects of it. Once you have an edge, once you are growing, once you have capital, like it starts to become a very psychological game, and you need to be on par with it, or it will show in your own performance as you start to make dumb decisions.
Yeah, I agree. I actually did a tweet just today saying how one major advantage of surviving long term in trading is that you get more used to drawdowns and you've sort of seen most of them. I wouldn't say you've seen all price action, but it is why when people say, even though it's a bit cliche, like your number one objective, at least in your first, maybe even first couple of years in trading, is just surviving. Because
Yeah.
once you put in those reps, you get a bit used to those motions of your equity curve, etc. You're so much more accepting of them, and you can think more logically through them. Like I remember my first drawdown, I was, I don't even know if I'd call it a drawdown. I thought I was losing like all my money. I was just completely, I don't know what the right word would be, just purely emotional. That takes quite a lot of repetitions to get used to, hey, like this money has been lost, but overall I know in the long term that money will be, hopefully recovered because I have a working strategy that has some edge or is collecting some sort of premium. You just have to put in those reps. I know that's very boring to say, but it's definitely very true.
Trading is a game of uncertainty, right? You get rewarded for uncertainty, and the early on you are in this game, like the earlier and earlier, the more uncertain the future is. So you are always stressing out of, am I going to be able to continue doing this? Like if the crisis comes along or something like that, and you only gain that confidence once you go through them. It's like I've been through the 2020, I've been 2021, like 2022 FTX collapsing. I've been to 2023, which was very hard for altcoins. Like you had a very good pump at the start of the year, then everything retraced basically. So I've went through so many cycles since 2017 when I started trading, like so many cycles, and I'm still here. That you gain, even though I know the future is uncertain and anything can happen, I have a bit more confidence than the guy that is starting this year, because I've been there. I've been through really nasty bear markets and I've survived. And that builds up your confidence over time. Sure, I've not yet been through a 2008 in the financial markets. I was alive, but I didn't have age to care. But I would like to go through one just to understand if I can survive it, if that makes sense. Because it makes my own understanding of markets more robust, and if I can survive them, right? Every negative cycle, I think I've learned way more than a positive cycle. It just reinforces what you have learned up until then, and if you survive, you grow and thrive. That's my view.
Yeah, no, I totally agree. I also think it's like getting used to the dollar amounts that you're losing. Now, while if you're sizing up slowly in trading, it's going to be kind of a constant recalibration to understanding, okay, I can lose this amount now, I can lose this, etc. Like I remember a very easy example for me is like starting out, I only had a $3,000 account. I think worst day I lost like 1.5K. It was like about half the account because I was trading small caps recklessly with a lot of leverage. And that 1.5K loss was devastating. It took me, I don't know, at least a couple of days to get out of the main emotion. And then it was more of like just a kind of the back of the head kind of pain of thinking about, oh, damn, I lost 1.5K in like a day. Nowadays, I could go into a 2-3K drawdown in a day and I'm just kind of used to it. Like it's definitely, no, I wouldn't say it's ever fully comfortable. Like you can sort of feel it, but that amount of trigger that happens to you is a lot less, especially over the years. Like I can't even imagine if you've been trading for 20 years, 15 years, it probably feels like child's play because at least that in 6 years in, it feels a lot less to a huge degree to what it was in the first year, etc.
Yeah, for sure. I also had like a similar experience. Like I remember having I don't know, probably $2,000 or $3,000 account back in 2017, 2018, and losing like $600 because I had messed up, and it was huge. It was huge. Like I felt so bad at that day, so bad. And it's funny because I pay probably that in funding in a few hours. No, not few hours, but in a day. Like I was looking at the funding numbers that I've paid this year alone, and it's like I've paid so much, it's crazy. And you start like remembering back, like even what I'm paying in fees today is what was a very big loss to me a few years ago. And it's true, you start to adapt as you grow, but it's a cool ride if you can handle the vol, but you really need that tolerance to pain, otherwise you are not going to make it here, and most people cannot.
Yeah, no, I totally agree. That's why, like, I'd say first year or two, just focus on surviving. Keep your risk very low, if possible. Don't focus too much on returns. Build up a really good foundation. I think we mentioned in the previous podcast, you can check out. We talked about a very simple kind of like trend following swing type kind of trading strategy you could just stick to and start. Just because that at least gives you the sense to get more repetitions in. Then you can go through your first drawdowns and things like that.